Data dump. Wall Street bets on SLV, silver. Silver has been suggested by many on the Wall Street Bets subreddit as a viable anti-short selling target once the operation in GME, GameStop, is completed. Silver is one of the commodities most heavily manipulated by the big banks, and has been so for decades. The short position in silver is considerable, and some of the most dirty banks in the business, including JP Morgan, have worked to suppress the price of the commodity for both personal profit as well as attempting to maintain the illusion of the US dollar's strength as a reserve currency. Silver is so focused on by the big banks because of its relatively small market cap compared to the gold market. Gold and silver tend to be highly correlated in price. Because of the correlation, the banks work tirelessly to suppress the price of silver to avoid a similar rise in price in the gold market. They often dump many months' worth of notional global mine production into thinly traded markets between the close in the United States and various openings in Asia. Such trading activity is not that of an entity attempting to maximize their profits, but one attempting to force the price lower while most market participants are out of the market, trying to clear stops that we just won't have. Such trades are actually rarely backed by the physical commodity, however. Paper trades in the futures markets generally run between 100 times to 500 times higher than the actual amount of physical silver available on the markets that can be actually delivered. This is called being naked short. The market is established in such a way that the assumption is that very few people will actually attempt to take possession of the physical silver, and instead simply accept a cash settlement for their futures contract. By drastically increasing the percentage of future contract holders that demand delivery of actual physical silver, either by holding future contracts for delivery, purchasing SLV or PSLV ETFs, or obtaining physical silver from retailers, we can force a massive short squeeze as big banks, hedge funds, and major institutions scramble to find silver that doesn't exist in the market, at least not at these suppressed prices. Much of annual silver production is consumed in industries like electronics, solar panels, and medical applications. While industry-wide demand for silver is huge, the amount of actual silver in each product is minuscule. So ultimately, the price of silver does very little to affect the overall price of these products. For instance, if a $500 smartphone contains $1 worth of silver at today's prices, if the silver price doubles or even goes up 10 times, it does very little to the overall price of the smartphone, which would only increase to $509 if the cost was recouped from the increasing price of silver. All the same, unless silver is obtained, no smartphone is produced. This means much of silver's demand is protected from even a drastic increase in price. The silver ends up in landfills and is not economical to recover at today's prices. It's also very difficult to ramp silver production because most silver is a byproduct of other metal mining operations like copper, lead, or gold production. Big new primary silver discoveries have been declining since the New World was discovered and the Wild West was tamed. Even if some mines currently in mothballs are newly discovered or put into production after a price increase, that process literally takes years to unfold. Compare this to a stock which, if push comes to shove, more shares can simply be issued. Much of the rest of silver's demand comes from investment. Many silver bugs, and myself included, have been holding physical silver either as a crisis hedge for natural disaster, war, or civil disturbance, etc., or an inflation hedge against the inevitable decline of the US dollar caused by ever-increasing use of the money printer. Many investors see silver as part of their core holdings, something they don't intend to part with unless it drastically changes their life circumstances, like buying a business or retiring. Besides just this, selling physical silver is something that takes a certain amount of effort, dragging it out, finding a dealer, shipping it, etc. It usually isn't sold quickly into a modest increase in price, and many held on to their silver through the 2008 to 2011 run-up because the fundamentals that caused the rise in price to that point were never addressed, and the crisis of 2008 was simply papered over. With now a second crisis fully upon us, the idea that the government, the Federal Reserve, etc., can normalize interest rates and stop intervening in the markets with the money printer has become even more ridiculous to suggest. Silver is trading well below its 1980 high, which isn't something you could say about most commodities. Speaking of 1980, that was the last time the gold price was high enough that if the United States could have returned to a gold standard and back every dollar in gold circulation with gold based on the reserves in Fort Knox. For them to do the same thing today, gold and silver would have to rise dramatically. Beyond just a rise in the silver price itself, a move in silver will likely cause a similar price in the rise of gold. Big players having missed the price rise in silver will pile into gold, and any stories of brokers failing to deliver on silver or forcing cash settlements of positions will get them worried about their own gold holdings, many of which are actually in unallocated accounts, which means there is not a one-to-one match with bars of gold equal to obligations the companies have with their clients. This is one of the major reasons why the Basel III banking requirements have been delayed continuously. These new rules will require unallocated gold accounts to maintain gold or cash at 85% to back up these accounts, and they have been unable to do this even at current prices. This domino effect very well could cause a scramble for gold and initiate a currency crisis that has been looming ever since attempting to solve every problem with the money printer has become the norm. Governments may very well step in and inform their central banks to revalue gold to a higher price level to back their currencies, assuming they still actually possess the gold that claims to be in their vaults. How to invest? The quickest way to invest is simply to put cash into SLV or PSLV ETFs. If SLV follows its own rules, it's supposed to obtain physical silver with the inflows into the fund. However, I would recommend we not rely on this idea alone because, as recent events have proven, the big boys have a habit of trying to change their rules as soon as they start losing. Another way to obtain physical silver is to buy future contracts and stand for delivery. This requires you make a minimum investment of 5,000 ounces though, so it's not for everyone. They may also try to screw you by asking you to cash settle, but that's not exactly what they want. A massive inability to deliver would be crushing to the legitimacy of these markets, which ultimately is a big part of the point here. At the end of the day, you may not want to be all in on either of these methods, considering the aforementioned inability of the big boys to actually follow their own rules. The alternative is to buy real physical silver. Avoid collectible coins, numismatics, or anything that tries to sell for a significant premium over the spot price. Junk silver, old pre-1964 U.S. coins, and rounds have been running for about $2 over spot. Government coins like Maples and Eagles have been closer to $3 to $4 over spot, but this can quickly change as stocks start depleting at retailers. Find a dealer locally if you want it fast, otherwise select an online dealer. There are a number of reputable online dealers. Ampex, SD Bullion, Silver Gold Bull, and GoldSilver.com are ones I have experience with, but no affiliation. Be prepared to pay by check, e-check, or bank wire to get the best price, and avoid credit card fees, which can run 3% or more. Buying from retailers will put pressure on the supply chain that leads back to the future contracts and wholesalers with a few extra steps. Plus, you'll actually have the physical asset in your possession. Once you have it, there can be no fuckery with rule changes, force majeure, cash settlement rulings in the courts, or anything like that. So I suggest that even if you are a big player in taking contracts, you at least get some physical in this manner, or roll winnings out of contracts into physical purchases to avoid being 100% screwed by the big boy rule changes like Robinhood and the other dealers tried to do before the GME and other stocks. Watch for delivery times. If a quoted delivery time is more than 2 weeks, find another product or dealer. 4 to 6 weeks could easily turn into forever in this kind of short squeeze scenario. If you don't have any silver in your possession, I would suggest 1 ounce rounds or coins before moving into the bigger stuff. It's hard to trade a 100-ounce bar for a week of groceries or a tank of gas if the shit hits the fan. 100 and 1,000-ounce bars are also easier to counterfeit. But if you're moving big amounts of cash, that might be unavoidable. Just make sure to get them from a reputable dealer. Miners. Silver miners are great in moderation because they will go up more than the price of silver based on their increased profitability. Buying them in and of themselves will not cause a rise in the price of silver, however. I would recommend only buying silver miners with a small portion of your overall investment in the space. Also, silver miners may just turn around and issue more shares once their price goes up. Also, governments may nationalize silver mines. Disclaimer and holdings. I am not a financial expert, and this is not financial advice. I'm some idiot on the internet. I hold the physical, and I like the metal. This has been Silver Busters signing off.